Okay, we will go ahead and call the March 20th Pension Committee meeting to order. Frida, do we have anybody signed up for public comment?
No, ma'am.
No problem. So our first agenda item is to consider minutes of the November 15th, 2023 meeting. Somebody have any changes or edits to that? If not, can I get a motion?
Motion to approve.
A second. Frida, can you call roll?
Yes. Vice Chair Jennifer Brown.
Aye.
Justin Burris.
Aye.
Earl Hall.
Aye.
Greg Sample.
Aye.
Kathy Smith.
Aye.
Aaron Tucker.
Aye. Okay, next we have Amy Krause of Acrisure to review our July 2023 actuarial valuation report for the city. Amy, are you on? I guess I should have confirmed that before we started. Good morning.
Good morning. Can you hear me?
Yes.
Wonderful. Good morning. Thank you so much for the opportunity to speak to you this morning and go over the pension funding report that was measured as of July 1st of 2023, which is the snapshot date, the beginning of each plan year. We take a look at the pension plan and see what's happened throughout the course of the prior year, and this report is really the basis that the city uses in order to come up with that actuarially determined contribution amount that is then funded for the fiscal year that will be starting July 1 of 2024. So before we go into the report, am I correct that you all have a copy of the report in front of you, so I don't have to share the report on the screen?
Yes, we all have that.
Okay. So before we open up the report, one thing that I want to mention just briefly is when you hired us, a year ago, we were Cowden Associates, and now you see that the report says Acrisure. What happened is Cowden Associates has been an agency partner of Acrisure for the last 7 years, and in January of this year, we rebranded ourselves as Acrisure, combining several other agency partners so that we were all known as one name. And so the team and the process, everything remained the same for the city. It's just simply the name of the company that you see on letterhead and emails changed from Cowden Associates to Acrisure, but there's no other changes in regards to that. So if you open, turn your page to page 5 in the book, we're going to look at some of the key assumptions, the key results of the report. And what we did is the prior valuation, that column from July 1, 2022, that was prepared by the prior plan actuary. And whenever you have a change in actuaries, one of the things that we do first is to try to put together a matching liability. And so we take all the information from the prior actuary, the data, the assumptions that they were using, all those different things, and then we program it into our system to make sure how we're valuing the benefits and how we're understanding the benefits is consistent with how the prior actuary is valuing those. And so when we did that matching process, we were able to come within 2% of the liabilities, and typically having a match within 5% is a success, is considered reasonable. So when you look at the prior valuation column, those were all part of the July 1, 22 report that USI had put together, and then you see the current valuation, July 1, 2023. These are the results that are contained within this report. And so we list both of them there for comparison purposes. Now, what you'll see as we go down is there's different key characteristics that are going to be apparent in this plan because of the nature of the plan. And so one of the big things being the plan is not open to new hires. And so we have a grandfathered group of individuals, and where you can see that right off the bat is in the participant count. So we divide the participants into different status categories. And so you can see that first line says active, going from 455 actives down to 427. Now the city itself, you have more employees than that, employed at the city at that time, but these are the remaining employees who are part of this pension plan and not closed out to it. The next category you see is terminated vested. So these are individuals who had worked for the city, were participating in the pension plan, and worked enough years to become vested in their accrued benefit, but they have since left employment and have not yet begun receiving the retirement benefit. So some of them could be too young yet in order to be eligible to receive their benefit. So they are individuals who are no longer connected with the city, but they do have a vested pension benefit that in later years they will come back and begin to collect on. The next two categories, disabled and retired, these are individuals in payment. We noted here that the prior actuary didn't distinguish if somebody had left because of disability or had left because of retirement. The plan does not have a subsidized disability benefit, so whether somebody leaves on disability or regular retirement, as long as they meet the retirement eligibility, they get the same benefit. For purposes of looking at future lifetime, so life expectancy of retirees in payment, we are going to start tracking them separately, and so that's what the note there is. After June 30th, 2022, there was one new individual who left on a disability, and so again, we're just tracking that separately for mortality and life expectancy purposes. And so any prior retiree who was disabled will be included in that retired count. And so you can see going from July 1, 2022 to July 1, 2023, the total number of retirees and disabled in payment went from 318 to 341, so 23 new retirements happening during the course of the year. Additionally, you have surviving beneficiaries that increased from 44 to 52 within that year for a total number of participants in the plan of 1,092 as of this valuation date. Now, when we move to payroll, again, this is a grandfathered group, and so even though the number of total actives decreased, there's typically increases in wages from one year to the next, and so you can see that the total plan salary had a slight increase, and then the average was greater, and that is in line with expectation. When we take a look at the assets, these are assets that are earmarked for the pension plan only to be used for purposes of the pension plan and the participants of that plan. And you can see that over the course of this year that we're looking at in comparison, going from $154 million to $164 million. So on a market value, which is investments that you have out there and money in the bank, essentially dollars that can be tracked, you had an increase of about $10 million. And then you see that second item under assets that says actuarial value of assets. And you see that it went from $169 million to $174 million, so about $5 million increase. And I'm going to, in a few minutes, we're going to look at that in a little more detail, but essentially the actuarial value of assets is a smoothing method. So the city is looking at this report in order to determine their funding requirement for the pension plan year after year. And we all know that the market, investments in the market can be very volatile. And so instead of the city having to have a funding basis that's very volatile, we use a smooth method that essentially will recognize gains and losses in the market over a period of time, so typically over 5 years. And again, we're going to, in a couple minutes, take a look at some components of that a little more closely, but that's the reason why the market value, you see an increase of $10 million, and then the actuarial value, an increase of only $5 million. The next three items on this key results page deal with the liability side. So we have assets set aside for these benefits that are paid in the future, and then we have to determine, as of this snapshot date and time, what are those liabilities? What are they expected to be in today's dollars? And so that first number, the present value of benefits for total service, that is looking at your current group of participants and projecting out how many additional years of service will your active employees continue to work and accrue additional benefits into the plan. And so that number is going to be the bigger one. So you see going from 230 million to 240 million. But what your actual funding is based on is looking at the next two components. So the first one being normal cost. Normal cost, you can see, went from 2.7 million to 3.0 million over the course of this year. And what normal cost is, it says how much will it cost the city to put money in the bank today in order to fund the additional accrued benefit that those employees are earning for the coming year. So the additional accrued benefits are going to be based on them working additional year of service, and then also an increase in their pay, which all gets factored into their retirement benefit when they do leave the city and when they do retire. So if the plan was fully funded, if assets in the plan were equal to the liability of the plan, then each year you would still have to fund the normal cost, because that's additional liability expected to be added to the plan. Now, the expense item of it is because the city, which it's permitted to, uses assets of the plan in order to pay expenses that it incurs on behalf of the plan. So actuarial expenses is included in that, and other administrative expenses and things such as that. And so again, when we're looking at this, the analogy that I like to use a lot is thinking about a credit card. If you have a $0 balance, then your assets are equal to your liabilities. But then you have a normal cost, so new charges coming in because people are working more and accruing additional benefits. And then you also have expenses. Think of those as new charges coming in. And so in order to maintain that full funding, you would have to pay whatever that new balance is, the new charges coming on. Now, the actuarial accrued liability, this is looking at what have the participants of the plan earned to date. So remember that present value of benefits, the total service, that was projecting out into the future. The actuarial accrued liability, that says what has actually been earned today. And so in a perfect world, what we would like to see to say that the plan is fully funded is that assets would be in line with this $216 million of total accrued liability. So if we look at the $216 million compared to our smooth actuarial value of assets, the $174 million, we see that the plan is currently funded at 81%. Okay, so the difference between the two is a shortfall of $41.6 million. Okay, so then at the bottom of the page, these are the actual funding numbers. Okay, so based on everything that is up above it and throughout this report, this is kind of the meat of what you as the city is looking for from this report. And it's the actuarially determined contribution percentage. Now, there's a couple things I want to just kind of step into these components to give you an idea of what would be expected based on your plan. So the normal cost, we want this to be level because the method that's used within this plan is an entry age normal percentage of pay. So essentially what that says is the amount that you have to pay each year should be based on a level percentage of the pay. So as people's pay increases, the percentage that you have to contribute based on their pay should remain the same. Okay? Now, plan expenses, again, that's the second piece under the normal cost up above. The expenses, we would expect this percentage to increase each year because of the closed group. So we have less actives every year coming in, but the plan expenses themselves will remain consistent or even increasing with inflation. And so you can see that there was a slight increase of 0.05%. So that's within what we would expect from year to year. Now, the amortization of unfunded liability, this is where the volatility of this actuarially determined contribution comes in. Okay, the normal costs we expect to remain pretty level from year to year. The plan expenses, we expect those to increase as the group of actives still participating in the plan decreases. But then the unfunded liability, so for July 1, 2023, we saw that the unfunded liability was about $41.6 million. So if we go back to the credit card analogy, this means that there's an outstanding balance on our credit card, and we have a minimum payment to try to pay off that balance over time. Okay, so when we have a really good year in the market and that helps drive up our asset side while the liabilities are remaining what we expect, then this percentage for the unfunded liability we would expect to come down. But it can be volatile from year to year just based on gains and losses that we see, and that's why it's important that we look at the assumptions that we're using behind our liability determinations. Essentially, assumptions, they will not determine the true cost of the plan, because if people live longer, you have to continue paying them. So even though maybe the mortality assumption says people will only live till 85, but if somebody continues to live past 85, you don't say, sorry, we were planning on for you to not make it past this year, so there's no more payments. You have to continue paying them. And so the assumptions that we use really influence the timing of the funding of those benefits. So if we only assume they live until 80, we're funding the plan based on that. But then if they continue to live after that, then we have to pay more on the back end because they're still receiving payments. But if we today assume that they're going to live until age 90, then we put a little bit more in the plan today in order to fund those benefits in the future. Okay, so I talked to Aaron and Jennifer, and we're going to come back to present to this group in a few months to talk about some of the assumptions that are used within the report and provide some recommendations. And so I'll leave some of my commentary for that meeting where we can explain some of the things, why we're recommending it and what kind of impact it has, and make sure that you're making these funding decisions, how to fund the plan based on reasonable assumptions and are informed that way. So if you turn the page, we're going to go to page 7, and this starts a look at some historical information on the plan. And so you can see on page 7, this is looking at, it shows market value of assets, which is the dark blue bars on the table, and then actuarial value, that smooth value of assets, that is the light blue bar. And then the red bar represents the accrued liability. So based on funding standards to be 100% funded, the accrued liability would have to equal that actuarial value of assets. So again, you see the plan's currently 81% funded, and you can see the funding status throughout the past 10 years there. So Aaron had asked this before, and so I want to just take a moment to mention it here. Within the Tennessee Code, there's really nothing in the code where the state would raise red flags or concerns based on funded level until you are down below 60%. And at that point, they just have some restrictions on what you can do. But, going from low 90s down to low 80s, there's still a lot of things kind of riding out within the pension plan. It's pretty consistent with some other governmental municipal plans that I work on, and is not of great concern from my end of things, and certainly nothing within the Tennessee Code that would put the city at risk of anything from the state level coming in. So I'm going to pause there just to see if there's any questions currently, and then I can continue on.
Are there any questions?
Yes.
Okay.
Number one, is it our job, or this is for the panel, I don't know, to keep this plan as close to 100% funded as we're supposed to?
Well, I think our responsibility is on the fiduciary side to make sure we're being responsible with the plan assets. We're reviewing the investment allocations, reviewing periodically the actuarial assumptions that Amy referred to a few minutes ago, that she's going to come back in a couple of months to reevaluate. I don't know that, I think we need to ensure that the plan can meet its liabilities, but I don't know that we are tasked with being making sure it's 100% funded.
Okay. Is that not a disturbing trend when we've fallen from 90 to 81 in one of the best markets we've ever had? We're at the all-time highs in the markets.
This is Chris from Fiducian. If I could jump in for a moment, I would say to Amy's point, the actuary, I think she's done a great job here. And looking at the trend in the funded ratio is pretty consistent. Yeah.
I'm sorry, we're having a little difficulty hearing you. If you could maybe speak up and just a little bit slower, I'm sorry.
Okay, is this better?
Yes.
Yeah, it's better.
That's better. Sorry. So I would think there's a couple factors driving this trend. And as Amy said, it's fairly common across the municipal landscape. Most municipal plans have lowered their discount rate over the last several years. Also, mortality tables, people are living longer. That's had an impact on funded ratios. So the initial knee-jerk reaction may be the lens of investments, but there are also other factors which can, influence the funded ratio that you're seeing. Across our public funds book here in Connecticut, I would say 75% funded ratio is pretty common. But again, those levels have come down over the years because of lower discount rate assumptions and higher mortality tables.
Yes, thanks, Chris, for jumping in. Those were some of the similar comments that I would have made as well and what we have seen. And I will also note that the Tennessee code and what's kind of behind the actuarially determined contribution, the idea behind it is that the city is making progress toward becoming fully funded. And the pension plan is a very long-term investment. It survives the lifetime of all these individuals, some of which are still actively working for the city. And so the back and forth that you see going on, part of that is plan sponsors trying to take risk out of those results. And so when Chris mentioned the investment rate change, when you lower your expected rate of return, that will drive up your actuarially accrued liability. And so when that happens, the funding ratio itself would fall, but you'd still be in a similar position as you were the year prior. It's just an assumption of what the future will be with those returns on your plan assets. And this page does not have the full history of when those changes, when that risk, that underlying risk was really taken away and out of the pension plan. And so the 81% funded that you see today may actually be a much better position from a risk standpoint as the 85% 2 years ago.
Are there any other questions? Okay, I think we're ready to move along, Amy.
Okay, thank you. So on page 8, this shows historical rates of return on the two different asset bases. So you have a market value rate of return and then the actuarial value rate of return. And this is a good illustration. That brown return line, you can see it's not as volatile. It tries to go in between what's happening in the market, which is the blue line that you see even within the last 3 years, how big of a change from one year to the next, being a positive 27% return, and then the following year, negative 12% return. So that just demonstrates the method that's behind that actuarial value. And again, trying to make sure that what the city is funding is more consistent and not jumping up and down as the market moves and being reactionary in that way. So the liabilities, we just mentioned how the expected rate of return drives the liability amount. And so currently the plan is expecting a rate of return of 7%. Now, when we talk about expected rate of return, again, I want to repeat how the pension plan is a very long-term assumption. And so while we see in different years we fall above and some years we fall below that expected rate of return, we're really trying to hit that target on a long-term basis. And so when we look at asset allocations, when we work with your investment managers and advisors, we're more concerned about the long term, the 20, 30 plus years that will follow with the pension plan, and then also making sure that you're in a position today that you can ride out the short-term volatility that's inherent in the marketplace. So if we turn to page 9, we'll look at some cash flows of the pension plan. So you can see for the fiscal year that ended in June of 2023, contributions that were coming into the plan about $6.3 million, and then benefit payments leaving the plan about $8.3 million, and non-investment expenses of $35,000 for a net negative cash flow of just shy of $2 million. Now, this plan is a mature plan, and when I say that, what I mean is the percentage of inactive participants compared to active participants will continue to grow. And so it's not that big, it's not a concern to see negative cash flow. What it means is that investment returns have to make up the shortfall. So they make up the $2 million, and then because the plan is unfunded, we also expect future returns on assets to help make up a portion of that unfunded amount. Okay, so moving on to page 10, this is a future look at expected benefit payments to be paid out of the pension plan. You can see from comparing page 9 to page 10, going from actual benefit payments of $8.3 million to an expected payout in the current fiscal year of $9.5 million. And this expectation is based on your current population of plan participants. So that could be that several of those active participants are already eligible to retire. And so based on the assumptions that are set, they would be retiring and beginning their payments in the near future. So this is something that can be used to try to determine what future cash flow might look like. The investment managers may be looking at this as they look into investments. If you're getting a lot of gains out of equities, do they reinvest them back into equities? Do they need to pull some out for cash based on what's coming up in the future? Those types of things. They would be looking at this for that purpose. Turning the page to page 11, this is where we look at the participant information. So again, I mentioned at the beginning, we separate the participants into two different status categories. And so this is a look at the history that we had available to us. And then the chart at the bottom, so because this is a closed group, no new hires are being put into the pension plan. You see that blue portion of the box slowly decreasing over time, where the inactive portion, so the brown, green, and purple, would be increasing over time. And the brown, that's their terminated vested group. So they're remaining pretty consistent over the years. And they're just a group of people waiting to start their benefit, whereas the green and purple, those are individuals who are currently collecting their benefits. On page 12, this just takes a little closer look to say, where did we start at the beginning of the year and where did we end at the end of the year? What happened during the year? So one of the big things I noticed is retirement. Okay, towards the middle of that page, you see from active employees, 26 retirements in the last year, and then those terminated vested group, 8 of those had retired. So 34 new retirements happening during that year. Additionally, the next line down, you see a number of deaths. So there were 3 terminated vested who passed away before commencing their benefit. 12 retirees that were collecting passed away, and then 1 surviving beneficiary who passed away. And of those 16 new deaths, there were 9 beneficiaries added. So sometimes a retiree can have a payment form that continues to a survivor, or the terminated vested individual, they never started collecting, but they may have a surviving spouse that is now entitled to a benefit in the future. Turning to page 13, this is looking again at your active population that are participating in the pension plan. And what I mentioned earlier, there's different levels for retirement eligibility based on if you're public safety. So police officers, firefighters, or if you're a non-uniform participant. But when we look at this table and look at the ages, look at years of service, we see that there's at least 50 individuals currently eligible for normal retirement, and then an additional almost 30 individuals eligible for early retirement. So again, my comment about the projected benefit payments, we have quite a few who could retire at any time during the year and start collecting their benefits. Now, the assumptions do extend out beyond normal retirement age, and so, you know, the prior actuary had recognized this pattern happening where people were reaching normal retirement eligibility, but they were not yet collecting their benefit. They were continuing in employment with the city, and there's many reasons behind that. I think that's a common trend just in our nation today, and you know, not going away anytime soon. And so that's something that we will continue to monitor going forward. Now on page 14, this looks at those inactive individuals. So the first three columns, retired, survivor, disabled, those are those currently collecting benefit payments. And this just shows their ages. So for retired, the earliest retirement age for any of the groups is age 55. So you don't see any individuals in the age group before age 55. And then the terminated vested, you see that they're in the earlier age brackets because many of them are not yet eligible for retirement. They have to wait until age 65. And really the one that is past age 65 is a deferred surviving beneficiary. And so beneficiaries have to wait until the participant would have turned 65. So if they are older than their spouse, it makes sense that they're still on that list there. But you can see at the bottom, on average, your retirees, when they retire from this, from the city and collect under this pension plan, on average, they're receiving about $2,000 per month. So that concludes the executive summary. I did just want to touch on a couple other pages within the actuarial exhibit. Really, these pages go into more detail with what occurred during the past year. And so if you turn to page 18, this is where we show the development of the smooth actuarial value of assets. And so you can see that the investment gain or loss, that's actual market gain or loss from year to year. And then you see that we defer recognition of it so that 20% of that gain or loss is recognized each year going forward. So it takes 5 years for the smooth value of assets to catch up to what happened in the market. And one of the things I want to point out is if you look at the sum of that gain or loss deferred, you see the $9.894 million. That is a loss that is still to be recognized within the smooth value of assets. So going back to the question that was asked earlier about the funded level of the plan, if everything goes as expected, so your assets return 7%, liabilities, everybody retires when we expect them to, and lives as long as we expect them to, those types of things, because there's still a loss sitting out there yet to be recognized, we would expect the funding level to decrease. Okay, so this is, again, just showing how that smoothing value factors in over time. And then, starting on page 24, these are the appendices of our report, but here we try to summarize the major plan provisions that we are basing our liability determination on. So it can be a quick reference guide. Of course, the plan document itself will determine binding provisions of the plan, but this is to give you an idea of how we look at the plan provisions, how we're valuing them. And then on page 26 starts our actuarial methods and assumptions. So when we took over as actuary for the plan, we saw that USI had put together an experience study about 5 or 6 years ago now. And so some of these rates are based on the actual experience of the plan, of your group. And so we will continue to monitor that. Typically, our approach is we monitor these things on an annual basis to see if there's recurring gains or losses, to see if anything needs to be tweaked from one year to the next. But then we also do a similar experience study. And so that experience study, we need to have a number of years of information, of data collected in order for it to be more credible. And so we will do that experience study probably within the next 4 years when we have some more years of information, but we will monitor the plan and the experience of the plan from year to year against what these assumptions are. And when we come before you again in a couple months, there may be some recommendations that we have with the assumptions, but again, we will discuss with you what the recommendation is, why we're making a recommendation, and talk to you about the impact of the plan. When we're setting assumptions, we are never dictating to the city what they have to do. It's a joint effort to make sure what we're seeing in the data and what being there in the city, what's to be expected for future salary increases, those types of things. We try to make it a joint effort to make sure we have what's best and have the funding based on what we currently know. So later on in the report, there are a couple different sections that talk about risk and maturity measures and different things. Those are things that are required by the actuarial standards of practice that are across all United States actuaries. And so there's a lot of commentary and kind of general discussion in there. But it's not something that I was planning to go over today. But if anything, those sections or anything else within the report, if you have questions that come up after today's call, I am available. You can call or email me directly, and I'd be happy to answer your questions and have further conversation. And that completes my report, unless there's any questions for me today.
Are there any other questions for Amy? I think this report is way more comprehensive than what we've received in the past, Amy, so thank you, and thank you for the thorough explanation of what all went into it. We will certainly look forward to hearing your recommendations on our assumptions later this summer.
All right, great. Thank you so much.
Thank you. Okay, so next we have Natalka and Chris from Fiducient to review our fourth quarter 2023 and our January and February plan performance, flash reports, and rebalancing recommendations.
Well, thank you, everyone. This is Natalka, and I think the way we'll structure this, our part of the presentation, is I'm going to have Chris lead off with just some commentaries, broad market commentary, to put the perspective of the plan's performance in line with what the markets were doing at year end, and also the start of 2024. And then I'll come back on with some specific performance commentary. So, Chris, can you give us a little update on the markets?
Yeah, happy to do so, Natalka. And good morning, everybody. I know there was a comment earlier that the markets have been hitting new highs, and that is correct. Good news is that the portfolio has been participating in that rally. Because we have a couple deliverables in front of the board today, I thought what I would do is just kind of provide a refresher on fourth quarter results and where we are today. We did have a solid fourth quarter ending December 31st, 2023, right? Interest rates declined sharply on expectations that the Fed would cut rates in 2024. That drove outsized returns for fixed income, and global equities rallied as well. In fact, as Natalka will point out, the pension portfolio rose 9% in the fourth quarter. In January, we gave back some. Right, the portfolio was down just under 1%, although we did outpace our benchmark by about 40 basis points as interest rates moved up a little bit higher. International equities and REITs were down during that period, but our underweight to REITs in the portfolio versus target helped performance. In terms of February, the February flash report that the committee has, interest rate volatility continued into February, given data points on the economy and inflation, which created uncertainty on the timing and magnitude of rate cuts in 2024 that the market had come to expect heading into the year. So that big rally that we had in the fourth quarter where rates came down, rates have since moved higher as inflation has remained relatively sticky. The Fed is meeting today. Market doesn't expect cuts at this meeting, but the markets will be focused on clues for monetary policy going forward. We believe we will continue to see a patient, data-driven approach, really, by the Fed, with no hurry to cut rates until there's greater visibility on inflation. But the yield on the 10-year bond has moved higher. It was up around 30 basis points in the month of February. So that yield moved from about 395 to 424, and that served as a headwind to fixed income results, right? So as interest rates move higher, there is that inverse relationship with bond prices. So as interest rates moved down, as they did in the fourth quarter, bond prices were sharply higher. As interest rates moved up higher here in 2024, bond prices have come under pressure. Global equities have moved higher for the month in February, right, with the S&P 500, the Euro stock, and Japan's Nikkei hitting record levels. And here in the U.S., equities moved higher during the month despite higher yields. Reported earnings growth for fourth quarter outpaced expectations, and we really witnessed a greater breadth to the rally, not concentrated in those magnificent 7 stocks, which had dominated the market for most of calendar year 2023. So small cap stocks with more attractive valuations heading into 2024 and the likelihood of rate cuts this year did outpace large caps for the month in February. International markets were higher. We had a strong month for emerging markets with strong results in China, fueled by government policy to address leverage in the real estate sector of the economy. So in general, we've had some challenges with fixed income in 2024, although the portfolio has held up well. But global equities have rallied, and Natalka will dig deeper into the numbers at this time.
Okay, thank you, Chris. If the committee wouldn't mind taking or going to the fourth quarter performance report, I'm just going to very quickly go over fourth quarter and 2023 performance for you. And then we'll move on to the February flash report for a year-to-date update on performance and asset allocation for the plan. But in the fourth quarter report, if you turn to page 15, which is just behind the executive summary tab, there is a table called the performance dashboard. It's very informative. It really provides you a good snapshot of the plan's market values, performance, and asset allocation. So I'll be working from that page initially. The plan began 2023 with $155.6 million in assets, and it finished 2023 at $172.7 million. During the year, there were $2.3 million of net outflows, benefit payments, and other plan expenses, and there were $19.6 million of investment gains. Most of those gains happened or occurred in the quarter, which Chris noted in his commentary.
Natalka, you're breaking up pretty significantly. I'm not sure.
Okay. Is this any better?
Yes.
Okay, let's try that. So for 2023, much of the performance gains and capital appreciation occurred in the fourth quarter. As Chris noted, it was a very strong quarter of performance across all asset classes, particularly fixed income. If we look to the left-hand table on page 15, we see a snapshot of the performance, both for the quarter and for the year. So, as Chris noted earlier, the plan was up 9.1% in the fourth quarter of 2023, slightly lagging the blended benchmark return of 9.5. For the year, the plan virtually matched the target index, up 12.8% versus 13%. So a very strong year of performance for the plan. On page 23 of this report, we can see the components of performance just broken out by your fixed income team, domestic equity, global and international equity, as well as real assets. On pages 24 and 27 are the details of the individual manager performance. I was just going to review for year-end the investment team's performance, but certainly if anyone has any questions on specifics, Chris and I will be more than happy to answer them. In 2023, the fixed income team topped their blended index benchmark, both in the fourth quarter, being up 6.8%, and for the year, they were up 7%. The plan's two multi-sector and high-yield managers, so that would be Western Asset Income and Lord Abbett High Yield, were the top performers in fixed income in 2023, rising 10% and 10.8% respectively. Your domestic equity team lagged in the fourth quarter and in 2023. The weakest links were your large cap value manager, Brandywine Global Dynamic Large Value, and also your mid cap growth manager, Janus Enterprise. Brandywine Large Cap Value was the only domestic equity manager to not rise double digits in 2023. Your largest equity manager, Pinnacle, large cap core equity was your top domestic equity performer, rising 26.4% for the year, matching the S&P 500 index and their target. Your global and international team have been strong performers for years, and 2023 was no exception. Janus Global Research was the plan's top performing manager in 2023, just edging out Pinnacle for top honors with a return of 26.8%. Your emerging markets manager lagged in the fourth quarter, but topped the index for the year, rising 11.5% versus 9.8%. Real assets rebounded strongly in the fourth quarter. Your real assets team is comprised of a global REIT manager, 2 domestic U.S. REIT managers, and also a commodities natural resources fund. REITs were a class that, like fixed income, during periods of the higher interest rates, were under pressure. When interest rates retreated after October, REITs were actually the strongest rallying asset class in the United States, as well as abroad. And your real assets exposure participated strongly. In 2023, the weakest link in your plan were commodities and natural resources, which rose only 3.1%. So that's a snapshot of how the plan's total performance was achieved in 2023. On page 29 of the report, for your reference, we highlight any investment managers that are on watch list status. There is only one investment manager that's on watch list status currently. That's TCW, Total Return, your mortgage-backed bond manager. They are not on a watch list for performance reasons. They do have 2 senior portfolio managers retiring in 2024, so we're watching their performance closely. On page 46 of your report, we review the investment expense ratios and the cost, the investment management cost of your plan. The fees, the average fee that is paid for the investment program of your plan is 52 basis points. And on page 46, there is the detailed fee schedule of each investment manager in your plan. The 52 basis point fee is quite competitive for a plan that does not have a lot of index fund exposure. You have primarily active managers, and you have 2 index funds, your small cap growth and your commodities natural resource. If we take a look at February performance, if you go to the February monthly flash report, once again on page 3, we show the performance dashboard, and your assets at the end of February have risen to $174.6 million. For the year-to-date period, so in January and February, the plan had $298,000 of net outflows and $2.2 million of investment gains. If we take a quick look at performance of the plan, for the month of February, you edged just ahead of the target policy, 2.2% return versus 2.1%. And on a year-to-date basis, you are slightly ahead. The plan is up 1.3 versus 0.7. One of the things also, if we move back over to the market value table on that performance dashboard, you'll see we have a column for fiscal year to date. So knowing that the plan year is June 30th, we are tracking your market values and gains and also performance through your fiscal year. And so from a fiscal year standpoint, your plan has appreciated from $164 million to $174 million, 174.6. Amy had mentioned some of those numbers in her presentation for the market values of the plan. And that equates to about a fiscal year-to-date return of about 7.25%. So, one of the things, are there any questions that anybody has on performance of the overall plan or any of your investment managers?
Are there any questions? I'm seeing none.
Okay. Well, then what we're going to finish off with is some comments on asset allocation, both current asset allocation and then also as part of our fiduciary governance process. During the fourth quarter, we reviewed the plan's strategic asset allocation and have made some recommendations to you as to forward-looking whether we think you should be making any changes, updates, or edits to the strategic asset allocation. If you go back to the fourth quarter report, I hate to have you moving back and forth, but your current asset allocation information can be found on pages 19 and 20. The current strategic asset mix of your plan is to be weighted 42% in equity, and that's both domestic as well as international equity, 34% in bonds, and 23% in real assets, and a 1% cash target. And you're currently underweight in fixed income, primarily due to performance, equities outpacing fixed income. You are overweight in both domestic as well as international equity. And you are tactically underweight in real assets. For the past 12 to 15 months, we've been trimming REIT exposure in your plan as that asset class has been challenged. And I'm going to now sort of turn things over to Chris to talk about the strategic asset mix and some of our comments on what we think the strategic asset mix might be going forward.
Great, thanks, Natalka. So if I could turn your attention to page 32, and the committee could see really the cadence of our fiduciary governance calendar. We designed the governance calendar really to engender discipline that outside of the investment review, there's a couple of topics throughout the year that we want to discuss with the committee. For example, in the first quarter, it could be a review of the investment policy statement. It could be fiduciary training. What are your responsibilities under Tennessee Code, under the Uniform Prudent Investor Act? In the third quarter, it's an overview of the municipal landscape. So we'll provide you insight into data points across 110 or so plans that we consult to around discount rate trends and funded status. And then this quarter, the fourth quarter, is really an opportunity for us to review our capital market assumptions and re-underwrite the plan's asset allocation to ensure that it aligns with the plan's discount rate, your investment return assumption. And if there's a silver lining to the bond market fiasco in 2022, it's the restoration of higher yields and the ballast that fixed income can provide in a portfolio setting. So for over a decade, right, as discount rates, as planned investment return assumptions have trended lower, asset allocations have remained relatively static. And that's a result of we're just unable to drive any return from fixed income. So the Fed had maintained that zero interest rate policy for so long. Interest rates were at historic lows, and there was only so much return you can generate from your fixed income allocation. Now, fast forward to today, with the Fed funds rate at 525 to 550, it's a different environment. It's a much different landscape, and one that we are embracing, one that any plan in an asset allocation setting should embrace. So if you look on page 34, when we develop our capital market assumptions, one thing that stands out is our higher expected returns on a go-forward basis for fixed income. And that's a byproduct of just a starting point where yields are today. So today's yields are the best predictor of future returns for fixed income. And these returns from 23 to 24, as you can see, are modestly higher, given that we're in a higher interest rate environment. If you were to look back 3-4 years ago, these returns were much, much lower because interest rates were low. So when you run some modeling efforts, right, on page 36, one thing that we're noticing is just really the increased opportunity across fixed income, right? I think a higher allocation to fixed income on a go-forward basis can provide more attractive risk-adjusted returns. And we're going to take a look at sort of the modeling efforts that we've done on page 38. So on page 38, what we've done is looked at the current asset allocation, which is 35% fixed income and roughly 42% global equities and 23% real assets, a combination of REITs and real assets. So even those would be considered equity-centric, so to speak. And the expected return profile for the portfolio is about 7.6%. So we're north of your discount rate. And then you'll see the annualized volatility is about 11.5%. And so then we modeled out various scenarios with incrementally higher fixed income allocations, whether it was 5% or 10%. And what you can see is with the restoration of higher yields on a go-forward basis, the annualized return for the portfolio still harvests about a 7.5 to 7.6% return, but we can reduce the volatility of the portfolio going forward. So we are having conversations with our clients in similar asset allocation settings of the restoration of fixed income, the higher yields, what impact does it have in a portfolio setting? And so we think opportunistically on a go-forward basis that this committee can consider incrementally higher allocations to fixed income that can produce better risk-adjusted returns than where we're at today. So you can see the +5 and +10 allocations to fixed income going forward can achieve really attractive risk-adjusted returns. Now, if the committee is inclined to move forward with modest allocations of fixed income, this could be done in a judicious manner. We don't do this overnight. As an example, we would dollar cost average into higher fixed income over time, over a 6-month or 9-month period. And that's simply designed to mitigate equity risk and interest rate risk, the timing of such, and that's why we don't do it all in one full swoop. So I'm going to just pause for a moment and see if there's any questions from the committee on these various scenarios which show incrementally higher allocations of fixed income on a go-forward basis.
So,
I don't have any questions. I don't like it, but I don't have any questions.
yeah, I understand. Yeah, I'm kind of in the same boat. The fixed income, I can understand to reduce the volatility, but it also, I thought I heard y'all earlier say that it had lower returns and wasn't quite meeting expectations in our previous market analysis. So,
Your assumption, I assume, assumes a fairly certain outlook that the Fed is going to get inflation under control and eventually rates are going to come down, because I assume part of that return has to do with the appreciation of bonds, correct?
Yeah, a key component of that as a starting point is where current yields are. That's going to drive a majority of the return. To your point, yes, if rates do come down, that will drive bond prices higher. At the same time, yield or coupons will be lower.
Well, yeah, but that means you got to pick them at the right time. Right? You got to buy the bonds at their best yield if possible.
Well, this is the 10-year outlook, right? So it's going to have various, the return profile is within that annualized volatility. It's going to fall out within that profile. We believe over a 10-year period, the annualized return for these three scenarios is around 7.6. But you're going to have less volatility because fixed income has less volatility than equities do. So again, my earlier comments were, for the last decade, the expectations for fixed income were minimal because you couldn't just harvest any return. It's sort of a mathematical exercise. If I have a yield at 2%, I can't expect a 6% return of fixed income. It's not going to happen, right? Unless you get really risky in fixed income and you're, predominantly high yield. But we're talking about kind of core strategy here. Now that yields are significantly higher, the return profile on a go-forward basis is much more attractive than it was even just 3 years ago, or 2 years ago, for that matter. So again, we can revisit this exercise with the committee. Again, we didn't expect any decisions today. I think the good news, though, is the role fixed income can play and will play in the portfolio on a go-forward basis, designed to temper the volatility with equities. I think the bigger question is, let's assume the plan's funded status does improve. Do you gradually sort of take a little risk off the table and step into fixed income more judiciously?
well, I certainly think that makes sense from the risk side.
Right. I think that, I was going to say, Aaron, that if you look at the graph on page 38, what we see is a pretty consistent annualized return, expected return outlook for the next 10 years of 7.6%. And it's all about the volatility management, right? And so just highlighting that you have the opportunity, because of what's happened with the interest rate reset and where current yields are as a starting point now, to not impede or reduce your expected annualized return, but reduce the volatility. So we thought it was a pretty good trade.
Right.
But the other thing that this exercise underscores is that your current strategic asset mix is meeting your actuarial interest rate assumption, the discount rate of 7%, which is always important for a defined benefit plan. So even if you chose to not make any adjustments and to leave the strategic asset mix in place, a couple of things that the committee should consider is, I had mentioned, we've been tactically underweighting REIT exposure for the last year, 15 months. So your REIT exposure, the target is 17% currently, and you're probably right now closer to about 13% in REITs as we've been trimming those. So, we can certainly keep it a tactical underweight. We might also, the committee might want to think about sort of changing the strategic asset allocation to make that a more permanent reduction with REITs. So, we just thought since the strategic asset allocation review sort of takes place in the fourth quarter at Fiducient, because that's when we also update our capital market assumptions that we used for input, that we would, sort of reserve any changes to the strategic asset mix pending the total review. So you now have sort of updated capital market assumptions and the impact it could have on expected returns and volatility, and you sort of can make decisions as to how you want to potentially address any current strategic asset allocation decisions if you don't make a broader change.
So you said a few minutes ago that y'all were not looking for a decision today. When would you be looking for a decision?
I would say over the next quarter or so.
I'm not opposed to making
It doesn't mean you can't make a decision today. I think, at a minimum, the 5% allocation of fixed income, we could probably step into that in a relatively, quicker time period. And we think the trade-off there is similar return profile with a little bit less risk. But we do that in a kind of a judicious manner, right? If equities rally and rates move up, maybe we pick up the pace. But again, it'll be sort of a dollar cost average to step into that allocation on a go-forward basis.
Yeah, I mean, to me, it seems like the flip side of less volatility is more certainty, and it seems to me that that's what we're craving here is certainty. So I would think that this would, if the actuarial projections are true, then if we're still going to get 7.6 with less risk, that seems like it's an obvious choice.
Right.
So.
I don't disagree. I'm an accountant, so I like less risk.
I'm a banker, so same thing.
Well, does the committee want to go ahead and vote on?
I think the only question I have is making sure that we're meeting all the state laws as far as the investment allocations and what they allow for what we can invest in, because I know that there are laws as far as our investments and what we can invest in and what we can't as a government entity. So because I see here that we're increasing the global investments for the global and the international with what is being proposed. So if we can just double check and make sure. So I agree with reducing our risk, but if we can motion contingent on meeting those laws.
I'm happy with that. Natalka or Chris, can y'all speak to how this asset allocation compares to what TCA allows?
Well, you've had global and international and emerging markets exposure for many years now, so it's allowable. We can certainly check and see if there is minimum and maximum, or most importantly, any cap ranges on how much exposure the plan can have. But certainly the current investments that you have are permissible.
Okay.
Is the concern that a banned nation might be part of that investment? Like,
The concern is that there's a maximum limit that we can put into the international markets.
oh, okay.
But to your point, if a motion is made contingent on confirmation that this allocation meets state law, then I think that's an appropriate motion as well, so.
And who makes that ultimate determination?
We would ask Fiduciant to confirm that.
I'll make a motion.
Okay. And are you making the motion on mix 1, 2?
Contingent upon,
State law?
yes, yes.
And are you making the motion on the mix 1 with the increasing to 10% fixed income or 5?
I'd say 5.
5? Is there a second, or do we want to have discussion about that motion?
But
No, I don't understand. Which,
So we mix 2 is what.
Right.
mix 2, you're saying?
Right, mix 2.
Is it,
Unless we want to go with, 10% and a little more fixed income, a little more certainty.
I would move that we would do mix 1 contingent upon what Jennifer talked about with regard to investment complying with state law. I don't know that we want to slow walk it. Just
Right.
That's fair.
And as the market fluctuates, we may go above or below our targets depending
Right.
on the market, short term.
So I can rescind my motion for mix 2 then.
Do you want to, so are we going to go with, Greg, are you making a motion?
I'm making a motion for mix 1, subject to the state law requirements regarding investments, yes.
Okay. Can I get a second?
Second.
Okay. Brady, could you call roll?
Okay, well, I will.
We'll need to vote real quick, Natalka, sorry.
Oh, okay, sorry about that.
Vice Chair Jennifer Brown.
Aye.
Justin Burris.
Aye.
Earl Hall Jr.
Aye.
Greg Semple.
Aye.
Kathy Smith.
Aye.
Chair Aaron Tucker.
Aye. Okay, Natalka, you were saying, I'm sorry.
Oh, yeah, no, I was the one who interrupted. So I will check into the Tennessee law and see if there are any market caps on international or global equities.
Okay. And
Thank you, Natalka.
that is reducing our equity exposure just barely. It looks like it's really just that main, change between the real assets and fixed.
Correct. The main reduction is in real estate, a little bit in commodities.
Real assets.
And
Yep, which we're already working away from, so.
And that's been one of our worst performances.
Yes.
Okay, I'm good.
Okay. Well, is there any other business to come before the committee, or Natalka or Chris, did y'all have anything else to add?
Nothing on my end.
Okay. Well, we will adjourn the meeting. Thank you, everybody.
Thank you both.
Thank you.